Dick, thank you very much for doing this interview. This is the second that we've done, and the last one you were setting up the Office of Financial Research and giving us an overview of the activities, and that still is a very precious video for me and my class, because I think it's a real insight into what you were trying to do by way of marshaling information and closing various gaps. Now that you're a professor, I'd like to take up our discussion again. And what I really want to do is to talk to you about financial stability in a very fundamental sense, and maybe to ask you to start with the question: what is financial stability? What is it? What does this term mean, and why has there been so much emphasis, so much discussion, so much analysis about financial stability over the last several years?
Well, it's a great place to start, Jeff. So, my answer to that question is the same as I would have given you 7 or 8 years ago. It's financial stability is the ability of the financial system to deliver its services even under stress. And, for example, to provide credit to credit-worthy borrowers, to provide liquidity to those who need it. And it's pretty clear that we didn't have financial stability in the financial crisis of 10 or 11 years ago.
So how do you account for the fact that the focus on financial stability was, in a sense, so long in coming? What was in the minds of policymakers and people in the markets, let's say before 2008, that kind of led to a lack of focus on financial stability?
I think there are two things, Jeff. One is complacency. I think people assumed, and the policymakers and market participants both assumed, that we had a long period of relatively stable economic growth, low inflation, and that would lead to financial stability. The second factor, I think, is that people tended to look at financial regulation in a piecemeal way. They looked at individual institutions, they looked at our institutional regulatory framework. They didn't think about what we needed to do to assure the stability of the entire financial system.
So would it be fair to say that one of the things that has changed here is the focus, system-wide focus? Or to put it another way, it wasn't enough, or it hasn't been enough to regulate individual entities. There's actually something over and above that, and that is to look at the entire system and all its components and try to figure out how to ensure that they work even in an economic downturn.
Well, I think you put your finger on it. That's really the whole ballgame. To think about the financial system as a system is one of the key factors that has changed since the financial crisis. Many of us knew that to begin with, but we didn't appreciate the extent to which problems in one part of the system could spill over and affect the others. So I think that's a big, big change. Maybe the most salient change since the crisis.
So if you start with the premise that many financial institutions are well regulated, and that you have central banks that look at the banking systems in their various countries, particularly the big central banks, when you talk about overseeing the system, what was missing by way of oversight? In other words, how do you go from regulating individual components to the whole system? What are the gaps that need to be filled by way of oversight?
Sure. I might dispute your premise because I think it's a hypothetical. But given the hypothetical
You mean hypothetical that the institutions are well regulated?
Correct.
Okay, we'll start there then. Let's say
correct.
let's design a system based on what we have today and make it so that you're actually looking at system-wide financial stability. What are the gaps that exist?
So there are several gaps that still exist, despite the fact that we put some things in place to make the system more resilient. And resilience is a key word here because financial stability is about resilience. I think many people don't understand that it's not about the absence of volatility. It means that the system can really function, and when vulnerabilities are exposed by shocks in the system can still function. So there's an interaction that's important between how we regulate individual components and firms and how we regulate and oversee the system as a whole. Both matter. Even the practice of risk management within the firms is important in thinking about how resilient are the components and how resilient is the system. In fact, I created a course that I taught in the spring that was based on that premise. I think that we've done a lot. I think we've aimed at a couple of important goals. Not only have we thought about the vulnerabilities in the system that might be exposed by shocks and how to mitigate those vulnerabilities. We've also thought about the moral hazard that exists because firms, when they take actions, may be, doing things that are in their benefit but not to the benefit of the system as a whole. Because if things go bad, then the taxpayer may be socializing losses. And that's exactly what happened in the crisis. So what we've done there is we tried to increase capital and liquidity to make firms more resilient and to create incentives, market incentives for them to self-insure. And we also, I think, importantly, monitor what those vulnerabilities might look like in peacetime. That is, in periods like now, when markets are calm, when things look good, when people get a little complacent about risk. This is exactly the time when we need to be vigilant and monitor the buildup of potential risks and vulnerabilities.
So let's just focus on this issue of vulnerabilities. If you had to catalog the 3 or 4 key vulnerabilities at a time like like now, where things seem to be in reasonably good shape, just sort of generically, what kind of vulnerabilities would worry you?
I mentioned complacency. That's one at the top of my list.
Right.
Second, I think that, while we've learned to deal with some of the financial risks, credit, market, liquidity risk, and so on, we have seen the rise of operational and cybersecurity risk to the top of our worry list. And we don't yet have good tools on how to deal with those. Coming back to financial risks, we're in a period where, particularly in America, non-financial corporate credit quality has deteriorated, underwriting standards have deteriorated, and we're now in a period of rising interest rates where some of the firms who've taken on a lot of leverage may have to roll over their maturing liabilities at a time when it may not be so easy to do that. And last, I worry about the plumbing of the financial system. And by that, I mean the system of payments, clearing, and settlement, and the centrally cleared counterparties who make up important components of that plumbing. Those were set up in order to help people net risks against each other, and that's an important function, an important benefit. But the process also concentrates risk in these CCPs and doesn't eliminate that risk. And so I worry about whether or not we have the capacity to mitigate the risks that can arise in CCPs.
So you mentioned, bank capital. That's obviously one thing that's been done. And that's been done, my understanding, it's been done within countries, and there is a kind of an international agreement on suitable levels of capital. Can you point to a few other things that have been put in place or that have been recognized as being needed that basically deal with these vulnerabilities that you're talking about?
Sure. One is that for banking institutions, we've also required them to hold certain levels of liquidity to meet unexpected needs. Now, my view is that in a real crisis, no amount of liquidity holdings by an individual institution will suffice. But having a buffer there is a good thing, not a bad thing. Second, in addition, in order to calibrate these things, in order to account for the fact that we can't assess counterfactuals in our financial system, we use stress tests as a tool to assess the resilience of financial institutions, and we are starting to think about how to do that for the system as a whole. That's still a work in progress, but we're thinking about that. And I think we're also, we have developed a framework that's incomplete, but at least it's a framework for resolution of a large, complex financial institution. Resolution is a term of art that for a smaller institution might involve liquidation. It might involve putting the firm out of business, transferring its assets to another institution, or recapitalizing it and reopening it. For a large, complex institution, that's very difficult because it is both large and complex. So we have a framework for doing that, but it's untested, and there are lots of people who don't like the framework that's been developed. So there's still a big debate about what to do there. And last, I would mention the fact that we've made strides in improving the quality of information that was a big gap prior to the crisis. One of the reasons that Lehman failed was we didn't know who was exposed to whom. Now we have some tools that help us understand that, but their use is incomplete, and we need to pay a lot of attention to the quality of the information that we have. Otherwise, our ability to analyze risk and to monitor it will really fall short.
So let me just follow up on this last point, because it's one that you were very involved in when you were at the Treasury, and it's also something that Andrew Haldane has emphasized. He's nice enough to come to my class a couple of years ago, and he was talking about mapping the global financial system as kind of a prerequisite for a lot of the other things that you have been talking about. Mm-hmm. And so I think this was probably, I'm going to say, 2010. And I asked him at the time, how long would this take? Well, first I asked him, is he optimistic it can be done? And he said yes. And I asked him, how long did he think it would take? And he said, well, it could take about 10 years. It could take that long. So now we're in 2018. And I know you did some real path-breaking work in the Treasury here. In terms of the quality of the information, the mapping of who owes what to whom, the mapping of where the big risks are, give us some idea of where are we on the spectrum from total lack of good information to being quite satisfied that we've got a system up and running.
I'll give you a couple examples. One, in short-term wholesale funding markets, what we call so-called runnable liabilities. They're subject to run. Your colleagues, Andrew Metrick and Gary Gorton, and I have all written about that. And we have started to fill some of the data gaps in repurchase agreements, particularly in what's called the bilateral repurchase agreement market. So that's progress. I think Andy's 10-year time horizon underestimates the actual time it's going to take to do this. Right. Based on my experience, at least in the U.S. government, this stuff takes a long time to put into place. You have to get agreement from a lot of people. You have to, write new regulations. You have to make sure that everyone's on board. You have to go to the industry and make sure they're on board. All that takes a lot of time. So that gap that I just mentioned has taken 6.5 to 7 years to really get rolling, to fill. Another area is in derivatives. So Dodd-Frank, through Title VII, strove to make derivatives markets more transparent. And they did that in several ways. And one of the ways was to collect data through what were called swap data repositories that would be reported and would serve as high quality, low cost data collection points for regulators and for the public at large. Unfortunately, the rules that were written to collect those data in the first place were not specific enough. And so they collected the data, but you can't make sense out of it. And they're now going back to rewrite the rules so that they can make sense out of it. And that's a lesson learned, which I was alluding to, namely that if you don't do it from the start, you don't map out the way that you need to collect quality data at the start, then you're going to be in trouble. Jeff, let me add one more thing here that I think is really important. And that is, financial innovation is going to afford us the opportunity to change the way we think about this issue and some other issues. And it's going to mean that not just because of the advent of big data, but new tools that can analyze the data, and if we can use standards to make the data coherent, then we can advance our ability to have data that we can use effectively for compliance purposes, risk management purposes, financial stability monitoring purposes, where we can aggregate the data up and we can be assured that the data have integrity. But we've got a lot of work to do before that is going to happen. That's the vision. There's another 10-year time frame before that really starts to come to fruition.
So whose job is it to do this on a national scale, let's say in the U.S., and on a global scale? Because just listening to what you're saying, this financial system is clearly global, and it is only it's only a part of the puzzle to understand what's going on in your own national marketplace. So start domestically, start in the U.S. Who is it that basically is in charge of financial stability, or in charge of putting into place the foundation, the foundational components for financial stability? And then I'm going to ask you the same question on a global scale.
Sure. So traditionally, as you know, central banks have had that responsibility. Indeed, when central banks were first started hundreds of years ago, their role was to provide liquidity in times of stress to financial institutions and to the financial system at large. And that still is their role. So clearly the central bank has to play a big role. In the United States, however, we have two problems. One is that we have a very fragmented or balkanized regulatory structure. And second, 2/3 of intermediation in the United States takes place outside the banking system. So all the regulators have to be involved in thinking about financial stability. Now, as you know from having been in Washington, unless you have the authority to do something, then you typically are not going to engage in doing it. Dodd-Frank gave the Financial Stability Oversight Council certain authorities to overcome the fragmentation of our regulatory structure. In my view, they're not sufficient. And in the view of many, the Financial Stability Oversight Council is not living up to its promise. Nor, for that matter, was the institution that I directed completely living up to its promise. And I think that's partly because the authority was lacking, and partly because many of the other regulators saw what the organization was doing as in conflict with what they were trying to do. Those things, those collective action problems, have to be resolved in order to be effective. As we look around the world, I think other countries have done a better job, particularly the UK. They have put their financial stability infrastructure and the regulatory infrastructure under, under one roof at the Bank of England. And that structure has significant advantages because while they have a committee called the Financial Policy Committee, whose responsibility to engineer financial stability policy, they have people from the Monetary Authority, the Monetary Policy Committee, from the Financial Conduct Authority, from the Prudential Regulatory Authority, all sitting on that committee and talking to each other. And I can tell you from experience that that doesn't sufficiently happen in the Financial Stability Oversight Council. Other smaller economies have obviously an easier job of it than we do, but that should not deter us from thinking about how to do it better.
And how about, is there, when you think about the fact that there are a number of countries, each of which is attempting to create some kind of mechanism for financial stability. You have the Euro area, you have the UK, you have the US, you have China. Who's trying to oversee the collective of all these national efforts in such a way that, slow as it might be, we're all kind of moving in the same direction, or at least in a direction that is not incompatible one with the other?
Well, I think there are some international bodies that try to play a coordination role. The Financial Stability Board is clearly one. The Bank for International Settlements, which is located right next door to the FSB, is another. The IMF is a third. And, their efforts to convene and to get agreement on global standards for these issues, has been very beneficial. But there's a lot of work to be done. And I think, it's always hard because you've got sovereign countries who have their own laws that are different from each other. They've got their own ideas of how resilient they want their financial systems to be, which may differ from others. And as a consequence, you don't have exactly a uniform or level playing field across borders. And that is potentially a problem.
So if I were, I'm going to ask you a sort of a naughty question, but when I add up everything you're saying, this is what I hear. Financial stability has been identified as a very important priority. However, it is going to take an awful long time to get all the pieces in place. The U.S. itself is a very complicated situation given our fragmented regulatory structure. And there are lots of pieces both in the U.S. and globally that are still, let's say, in development. And so if there were to be a major financial crisis, we still have an awful lot of problems that could flare up because we're in a major transition. Would I be right in summing it up that way?
I think the question is whether it's a glass half full or a glass half empty. And I prefer to look at it as a glass half full, but it's decidedly half full. We have made progress. We do have some global coordination. We do understand what some of the sources of the vulnerabilities in the financial system globally and domestically really are. And we have some tools to deal with those things. But we still have a long way to go. And I am not convinced that when the next financial crisis hits, and there will be one, that we're going to be ready for its consequences, because it's not going to be the same as before. I think there's a good chance that it will not be as severe as the last one because we've made the system more resilient. But I also think that because it's going to take a form that we might not have seen before, maybe a cyber attack, maybe something else that triggers the next crisis that we're not thinking about or not thinking enough about. I think that we need to keep working at this. And as I said, I worry that people are getting complacent, and that that is important. I also, Jeff, think it's really important to think about a balance in financial stability, because it should not be an end in itself. It's a means to an end. It's a means to assure continuing economic performance. We don't want financial stability just to say that we've achieved it. We want it to obtain because we think it's good for our prosperity and for making sure that the economy and the financial system function and work together. So we are looking for a balance between making sure the system is sufficiently resilient and making sure also that the financial system can effectively deliver what we think it should deliver and make some money at it. I think that often gets lost in the discussion.
So you're not trying to eliminate risk, but you're trying to balance sort of risk with stability. Am I right?
Absolutely. I mean, elimination of risk would not be, if we had a financial system with no risk, then it really wouldn't be a financial system, because one of the functions of the financial system is to price and assess risk and to have people figure out how to deal with risks. We don't want to eliminate it. We want to understand how to manage it. And it's very important that people state to themselves and to others, how much risk they're willing to take. Some people are willing to take quite a bit. If they are, then we want to make sure that they have the resources to deal with things when they don't work out. If they are risk averse, that's fine too. They don't need as many buffers or resources in order to deal with risk management. And the diversity of our financial system really should foster the ability of those things to coexist.
So here's my last question. Since the financial crisis, or let me start a different way. During the financial crisis, there was a surprising amount of international cooperation. I think, the history of that crisis will be written over and over again for many years. But one thing that really stood out was that in the worst moments, there was a lot of coming together of financial authorities. And that was not only to stop the financial hemorrhaging, but also to inject stimulus in the system so the macroeconomic situation improved. Since 2008, 2009, there has been an enormous amount of effort around financial stability, which in theory would have brought a lot of financial officials together to get to know one another, to really understand where they diverge in their views, but nevertheless, a lot of collaboration and a lot of interaction among the people who would really count in the next financial crisis.
Yep.
On the other hand, we have seen in the global economy, a lot of I would say dissension about, especially around trade, but also around cybersecurity and this kind of thing. This is purely a guess, but I'm just wondering, do you think that if we were, when we have another financial crisis, let's just say, stipulate, over the next 5 or 10 years, do you think that we would be in better shape just because of the human interaction, or is that not as important as I made it out to be?
I think it's critically important. I think what's critically important is not just the human interaction so people get to know each other and you have a Rolodex, as we used to say in the old days, or you can look up their phone number and you know who to call, it's on your speed dial. But, and you have a relationship that makes that conversation quick and worthwhile and everybody knows what to do. But But we need and we are, we need to and we are engaging in what people call tabletop exercises, which are like war games, in order to understand whose responsibility it is when things go bad to do certain things. It's a team sport, and that's globally true. And there's no way that we can escape that, because what happens in Europe is going to affect us, and vice versa. What can happen even in small parts of the world, small financial markets, if they become severe enough and the players are interconnected enough. So we wouldn't want to say that Venezuela and Turkey, for example, are examples of highly interconnected but small catalyst for instability. But the point is, when we think about exposure to Turkey or to Venezuela or to Russia or any other foreign entity, we don't just want to add up, the banking exposures to those companies. We want to understand who is exposed to them and who is exposed to their exposures, if that makes sense. So not only do we want to know who our customers are, we want to know who our customers' customers are and counterparties are, because the financial system is complex and interconnected. And if we ignore that, it will be at our peril.
Dick, that's terrific. I think you gave us a great overview of financial stability and I think a very honest view as to where we are on the spectrum of being unprepared and being as prepared as we really want, and also defined a lot of really key concepts. Thanks a million.
Thank you, Jeff.